Is FOMO, the fear of missing out, trumping the December's FOLO, the fear of losing out? Is this really a good spot to commit new capital? Three big technicals suggest you should not let your emotions get the better of you and fall prey to FOMO here. Watch this video and you'll see why this may be a Dirty Harry moment in the market. I'm Jeff Cooper, the creator of the Hit and Run methodology, popularized by my classic best-selling books Hit and Run Trading 1 and Hit and Run Trading 2. Since my early days at the famous Milken Group at Drexel Burnham in Beverly Hills, where I started my trading career in the early 1980s, I've been an avid student of technical analysis, diving deep into W.D. Gann's works in particular. Checking this daily chart of the S&P, the first thing we see is the index is challenging its overhead 200-day moving average. That's this magenta line here. This is often considered the bull-bear pivot. Of course, if you waited for the index to cross its 200-day moving average in October, let's take a look, you left a lot of money on the table. If you waited for the, likewise, if you assume that the S&P is a buy here on successfully clearing its 200-day moving average, and you waited for this moment, you've already left a mountain of profits on the table. And more importantly, you may be stepping into a trap at precisely the wrong time. This is what occurred in early November, right here when the index cleared its 200-day, and again here in early December as the S&P cleared its 200-day. They cleared it all right, but only for 1 or 2 days, as you can see, and then they abruptly plunged, especially in December and the Christmas massacre. So that's the fly in the ointment, when the T-Rex in the ointment, I should say, when the S&P clears its 500-day, it's always follow through that's key. So you got to ask yourself, is this a Dirty Harry moment? Are you feeling lucky? Is the third time above the 200 days since the fall top going to be a charm for the bulls or a charm for the bears? While the ball's been in the Bulls' court, it's up to them to prove there's been a change in complexion here after a 20% rally to this juncture. The second item I want to show you is that the S&P is also flirting with a declining trend line connecting its early November top and its early December top. You can see that trend line right here, highlighted right here, and we're there. The third thing I want to show you is the resistance defined by a trend line connecting the October low. So here we've connected the October high, the November high rather, and the early December high. And I also want to show you what I call a live angle. And this is a line connecting the October low, this is the October 29th, the late October low, with the November low right here, and extending this out. Notice that this was the breakdown point for the December carnage. So I connect these two trend lines and extending it out, I call this, it's what I call a live angle. Now pulling back the lens even further, going to a weekly, you can see that by connecting the big February low last year and the April low, this was a little bit of an undercut here in April, but connecting these, this was the successful test low, connecting these lows here also comes in right at this point where we are now. So we've got these three technicals to consider. You've got the 200-day on the dailies, you've got this trend line coming up from these lows here, this live angle, you've got the weekly, that's the daily live angle, you've got the weekly live angle, and you've got this declining trend line from the early November and the early December tops. Now, most of you are familiar with legendary trader Jesse Livermore and what he called, excuse me, the line of least resistance. I call these live angles the line of most resistance. Let's go back and you'll see what I mean. I call this live angle, and this is the weekly line here that comes in right in this area. I call these lines of most resistance. When you get a confluence of resistance like we have currently, it underscores the idea of a turning point. How will we know? Well, price, in my book, is the final arbiter. Trade back below this prior swing high here from last week, which is 27.39, is the first indication in the short term that we've got a potential turning point. The second indication is going to be a stab back below this morning's gap. Let's go to the hourlies. Actually, let's go to the 10-minute, and you can see what I mean. So here's today's gap up, and we pulled back right to the opening, and looks like we're putting in a little rising wedge. Again, this is very short term on the 10-minute. This is usually a bearish pattern, but trade below this open gap, a stab and stick. In other words, a stab back below this open gap, trade that offsets this open gap and follows through and sticks below it, will be the second indication that this resistance right up here is in fact a good turning point. And I call these trades back through an open gap a swish. So if we get a sell back below the prior swing high right here, let's there we go. So you can see now, zeroing down to this, drilling down to this, if we pull back and stab back below this prior swing high here from last week at 27.39, in tandem with closing this morning's open gap, that's your indication that the daily and weekly resistance are exerting their influence. That's it for now. With that, I'll let you go. Appreciate your time. Thanks for listening. See you next time.